Good morning. Welcome to this final webinar for the year, and thank you very much for joining us now in the second half of December, as we're all, I think, getting ourselves prepared for the Christmas and festive period ahead. We found that it was, with so much going on this year, that it was essential that we took the opportunity to brief members before we got to the end of the year. So I might start by introducing myself. I'm Phil Anderson, General Manager, Policy and Professionalism at the AFA. I'm joined by my two colleagues, Angela Karras and Mark Klobuchar, who will be assisting through the webinar in terms of answering or putting questions forward for me to respond to. So very much invite you to put questions in as we progress through the webinar this morning. The attendance for this webinar has been absolutely fantastic. We've had over 400 people register for it, and we're certainly looking forward to seeing those numbers come through. Right, so what I might do to start with is just reflect upon some of the very significant challenges that we've faced over the course of this year. And many of them will continue to be big issues for us into the new year. So if I start in the bottom right-hand corner, the Royal Commission has been something that was launched by the government in November of 2017 and has played out as a very important factor for many of the months since then. Fee for no service has been a continuing issue, played a big role in the Royal Commission, but it's also started to have a much broader impact around the financial advice marketplace. ASIC have then extended that to look at FDS as an opt-in, and we'll talk more in a little while about the project they have underway. FASEA has probably been the biggest issue. It's been going on for now over a year, and we're going to spend quite a bit of time talking about that this morning, in terms of what the latest proposals are, and then also in terms of what the AFA is recommending. The Productivity Commission investigation of superannuation, and in particular default superannuation, is still ongoing, and we're expecting a final report on that very shortly. We've got a couple of key pieces of pending legislation, and I'll talk about them briefly towards the end. We've had two major reviews of advice quality, 562 and 575, which both generated relatively poor results and will pose further challenges for us into the new year. And we've also seen from the 1st of November the launch of the new complaints body, the Australian Financial Complaints Authority, which will become a key part of our marketplace going forward. So the key topics today are professional standards and FASEA, the Royal Commission, the legislative agenda, so what the government is doing at the moment, what the regulator is doing. And we're also at the end, we're just going to quickly reflect upon what 2019 looks like, what the political process is, and what else we'll see that will be a key influence for next year. So I'll start with professional standards and FASEA. The first announcement that generated an enormous amount of concern and anxiety was the first announcement from FASEA on the 14th of December 2017, so more than a year ago, on education standards for existing advisors. This was an announcement that generated a lot of angst and also a lot of anxiety, and has continued to be a factor that's played out during the course of 2018. We've also seen, as a result of that, a lot of members talking to their local members of parliament, and that sense of concern has flowed through. And when we meet with politicians now, it is very much part of the discussion. How much are they hearing from their local electorate? Have they had financial advisors contact them? And it's very clear that the message has been getting through to them now much more broadly. Now, if we look at some of the key developments this year, the whole FASEA process has been playing out in instalments across the course of the year. So we had the major releases in March, we had consultation going through really from June all the way through to August. And then there was a quiet period until we had the Minister come out at our conference on the Gold Coast this year on the 12th of October and make some statements with respect to improvements to the recognition of prior learning that was being made available to existing advisors. We then had to, in effect, wait another month or more before we got further detail and clarity, and that has now started to roll out since the 16th of November. What I do want to do, though, is reflect also on the advocacy that has been going on. We've obviously been very active in participating with the consultation process with FASEA, encouraging our members to provide us with their own input and also encouraging you to make your own submissions to FASEA as part of this consultation process. But in terms of the lobbying over the second half of the year, we got to the point where some of the proposals that were coming out from FASEA, such as the exam, were of such concern that we specifically went to see the Minister at the time, Kelly O'Dwyer, to make it very clear to her that some of these proposals were generating a lot of angst, and the output of it could be a significant loss of financial advisors from the marketplace. We've met a number of times with the FASEA CEO, then the acting MD, and then the new CEO. We had a new minister come in from the end of August, and we met for the first time with Stuart Robert on the 18th of September. We also then had him at our conference. We've met again with him on the 26th of November, and importantly in that we've delivered some messages that reflect more broadly across the financial advice community the concerns that we have with the FASEA proposals. We've also had the opportunity to meet with a number of other politicians, and it's been very refreshing, the number of them who have been briefed on this issue, have been engaging with people in their local electorates, and are very conscious of the concern that these proposals are having on financial advisors and members of the AFA. Now, I think we need to be very clear on the principles that we are advocating on behalf of. One undeniable reality in the context of both the FASEA process playing out and also with the Royal Commission running through this year is that community expectations are that there is a lift in minimum education standards for financial advisors. Our battle is to make sure that that increase in minimum standards is a pragmatic, sensible increase, but it inevitably will mean that everyone will need to do some level of further study, and we'll talk through the details of that in just a moment. We've also advocated for other key elements to this reform. Equity. It needs to recognise the study and experience that you have over the course of your career as a financial advisor. And that's been one of the big battles that we've had, and it's a continuing issue for us. Sustainability is also critical. There's been extensive discussion throughout the trade media over the course of this year as to what the exodus of financial advisors might be if we don't get more pragmatic, sensible outcomes. And we've certainly shared our estimates of that outcome through the consultation process that we've had and in our discussions with politicians. One final point that is really important for us is that no advisor who's required to do further study wants to repeat stuff that they've done in the past. And in fact, what they want to do is something that will actually deliver value to their business, will be of interest to them, and will be beneficial for their clients. And this is really important when you're looking at specialists and what they might be required to do, because there is no point getting people to do material that they've done in the past or they're never actually going to apply in their business. So we will continue to advocate strongly on this, and we certainly are looking for further changes from FASEA to reflect that. So I want to just take you through the consultation process that's currently underway. And this has been a very intense period since it kicked off on the 16th of November. So on that, it was a Friday evening, FASEA released their blueprint document. They also released a couple of consultation papers, one around the professional year and the term that's used for provisional financial advisors, people doing their professional year. Now those consultations had a due date of the 30th of November and we have, as we've published for members, made submissions on both of those on that due date. Then on the 20th of November, we saw the legislative instrument and other supporting documents come out with respect to the education pathways. The responses on that were due last Friday, and we have now submitted that on Friday, and we will make this submission available on the website today, and we'll cover some of the key recommendations in the webinar this morning. On the 21st of November, FASEA released their latest draft of the Code of Ethics. The consultation on that is continuing with a response due tomorrow. So we will be very busily working to finalise our submission by close of business tomorrow. Then on the 22nd of November, we had the draft legislative instrument for the CPD policy come out with a submission on that due on the 7th of December, so the Friday before last. Then on the 30th of November, we had the foreign qualifications proposal come out, and that was due and submitted at the same time as the education pathways submission last Friday. And then finally, late last Friday night, we had the exam draft legislative instrument come out. Now that is due on the 4th of January, so we have a little bit of time still to do that one. So as you can see, the last month has been a particularly busy time with FASEA progressively releasing documents, us responding to them, and releasing that information to members. So I want to summarise the education position. The practical reality is that everyone will end up in one of 4 categories. Now they are advisors, so this is with respect to existing advisors. You'll either be an existing advisor with an approved financial planning degree. And that's approved by what was in the past, the Financial Planning Education Council, and is now FASEA. The second category is those people who have a relevant degree. Now, a relevant degree is being defined as someone who has 8 subjects in what's classified as a relevant field. And that includes subjects such as accounting, economics, there are some law subjects, tax subjects, banking, investments. And we're certainly going to continue to argue to extend the fields that are included in that definition. The third category is people who have a non-relevant degree. And that's a degree that is otherwise not classified as relevant. So you don't have the 8 subjects in the proposed relevant fields. And then the final and the fourth category, and the largest category, is those who have no tertiary qualifications. Now, if we go back to what will be required for each of those categories, the first one, where you've got an approved financial planning degree, which only represents 6% of our membership base, you would be required to do 1 bridging course, which is a subject on the FASEA Code of Ethics and Code Monitoring. For the relevant degree, which represents 24% of our membership base, you'd be required to do a 3-subject bridging course plus 1 additional course, which FASEA have added in this latest round. They've also, however, provided recognition for prior learning for this group, so people would be able to access 2 subjects credit for having completed the ADFP or equivalent, and potentially a further 2 subjects for having completed a professional designation. Now, the third category is non-relevant degrees. 16% of our membership are in this category. The outcome for this group is that you would need to do 7 subjects as part of a graduate diploma, However, you would equally have access to recognition for prior learning for the ADFP or equivalent and or a professional designation. So someone in this category who had a non-relevant degree would start with a requirement to do 7 subjects, but if they had the ADFP and the FCHFP when it's approved, then they would be reduced from 7 down to 3 subjects. Now, our final category, those who have no tertiary qualifications, is a requirement to do the full 8-subject graduate diploma. Now, RPL equally applies for this group, so the ADFP or equivalent and a professional designation could bring that down to needing to do 4 subjects. Now, just to make a few points to clarify recognition of prior learning, where it talks about the ADFP, that also includes the Diploma of Financial Planning 128, the older DFP that was that many advisors have actually completed, and also the Advanced Diploma of Financial Services specialising in financial planning, which was the course that was available before the ADFP came along. Now, professional designations will include the FCHFP, although it is subject to us doing an application to FASEA and obtaining approval. Now, one other really important point to make is that FASEA have said these are the only 2 grounds for RPL for existing advisors. So it's the ADFP or equivalent and the professional designation. There is no further RPL that they're proposing to be available, and that is a point that we will fight very hard for, because the current proposal gives no mechanism to recognise experience. Now, at the moment, if an advisor with no tertiary qualifications was to apply to a university, they would expect to get some credit for experience. So that's a really important issue to continue to fight for. So what I want to do now is just explain very quickly the proposals that we have put back to FASEA as part of our submission that went in last Friday. So if we start, we don't have any proposals with respect to those advisors who have an approved degree. They will need to do the Code of Ethics subject, and that's something that we accept as a fair and reasonable outcome for them. When it comes to people with a relevant degree, and these are people who've done things like commerce degrees, business degrees, economics degrees, and to some extent law, we've proposed a range of things. First of all, we've said the field of study that is included needs to be broadened. And one obvious exclusion, which is hard to comprehend, was financial planning, financial advice, financial services subjects weren't in there. Neither was insurance, neither was superannuation. So we're saying those subjects definitely need to be added back in. We're also saying that where the previous proposal from March suggested that what was required was 3-subject bridging course, we're saying, well, it's not appropriate to go backwards, and the starting position should be that advisors with a relevant degree need to do 3 subjects. We're also recognising that this cut-off for having 8 subjects in a relevant field is very much a threshold, and you fall off the end of the cliff if you don't get the 8. So we want to have more of a graduated outcome where if you've got 6 or 7 relevant subjects, then you get 4 credits. If you've got 4 or 5 relevant subjects, then you get 3 credits. And the next level down is people who have a non-relevant degree. So they might have 3 relevant subjects. However, it's not enough to get over the threshold. So we're saying that people who have a non-relevant degree should get at least 2 subjects credit. Now, key point that we are making, and this would apply across all categories, is provision for recognising experience. The explanatory memorandum specifically refers to the ability to recognise CPD. So someone who's been actively practicing for the last 15 years, ever since the current licensing regime commenced, will have had to have done 15 years of CPD. they will have also done a whole range of other courses, either before the current regime started or as part of the other activity that they've undertaken, whether that's subjects in margin lending or other areas. Further study has inevitably been done. So we're saying to recognise both that CPD and other subjects and other study that people have undertaken is if you've got 15 years experience, you should get 3 subjects credit. If you've got between 10 and 15 years experience, 2 subjects credit. And between 5 and 10 years experience, you should get 1 subject credit. So the whole point of this is that advisors would then have the ability to access credits across 3 key areas: ADFP or equivalent, professional designations, and years of experience. Now, the one other key point that we have strongly emphasised in our submission, and I encourage you to have a look at the submission, which, as I said, will be on the website later today, is we're strongly advocating, and I've talked about this already, to give advisors the flexibility to study subjects that are of benefit to them and their area of specialisation. We're very conscious that there's been a lot of discussion around whether there should, for example, be a different category for financial advisors who are risk specialists. FASEA doesn't have the legislative capability to introduce that, and in the current political climate, those sorts of changes are not going to be possible. So what we're arguing for is to give them due credit for their experience and also give them the opportunity to study subjects that are of most relevant to them. Right, now I might just pause there and check in with Angela and Mark to see if we've got any questions that are worth posing at this point.
Thanks, Phil. We do have a lot of questions flooding in, and sorry about that little bit of audio there. I'll speak up so we just get it on the one mic. We do have a lot of questions flooding in. Just to address a few of them, we will provide copies of the slides and a recording of the webinar post-session as well. We will try to get that out by the end of this week, so it's just in time for everybody's Christmas break. Now, some specific questions around professional designations. We'll start with a question from Paul, who asks, do the CA and CPA designations also count for credits?
So the way that FASEA handled this, I think caused unnecessary anxiety, because on their first announcement with the blueprint, they suggested it was only going to be the CFP and the FCHFP, and they specified certain dates. Now, when they put the detail out on the 20th of November, they clarified it and said that it was up to professional associations to apply to get recognition. So that opportunity to apply for recognition equally applies across all of the professional associations that operate in this space. So we do not believe that it precludes certainly the accounting bodies from applying for recognition of their professional designations. Whether they would be approved is a matter for FASEA to determine.
Now, we've also got a question from Neil. Neil says he has the FCHFP and the CFP. Does that give him 2 or 4 credits?
Neil, it's our understanding that that would be capped at 2 credits. Unfortunately, it would be great to get more, but our feedback from FASEA is that it's going to be capped at 2 for a professional designation.
And Gail asks, when will we know timing on the credits available? Will they be eligible for any of the subjects in the grad dip?
So the interesting thing about this is that if you've got a relevant degree, you're not actually going to be doing a graduate diploma. If you've got a non-relevant degree, certainly if they give 2 subjects credit and you've got access to more credits, you may not end up doing a graduate diploma. And the reason for that is the academic convention is you need to do at least 50% of the subjects in a course to actually get that qualification. So with an 8 subject graduate diploma, you would need to do 4 subjects to actually qualify to get the qualification. So if your credits actually led you to a position where you had to do less than 4 subjects, then you wouldn't actually get the qualification.
And we'll just do a final question from Stephen before we move on. Stephen asks, the Chartered Life Practitioner designation, the CHLP, should be the same segment as the FCHFP. It's basically the same criteria, but the expectation of investments and emphasis on risk. Now, Stephen's put that through as a statement, but I'll phrase it as a question. Will we be applying for the CHLP to receive the same amount of credits?
Absolutely. You can get a categorical guarantee. We will be applying for full recognition of the FCHFP and the Chartered Life Practitioner from the time that they commenced being available to advisors to undertake as coursework. So given you've needed to do 4 subjects to get those professional designations, then they should certainly count. So we might just hold any further questions at this point, and we'll come back and open it up to more questions as we progress. I also want to talk about the CPD proposal. This is one that I guess you could say we've been fairly outspoken on over the course of the last week or so, because we really don't think this has hit the mark. So the proposal from FASEA is that rather than what they previously suggested of 50 hours, they've reduced it to 40 hours. We still think they could come back to 30. They've suggested that 70% of the CPD activity would need to be approved by the licensee. But that opens up the question of, well, what happens with the other 30%? They've also put a cap of 4 hours on professional reading, which is interesting because we refer to what the other associations do, and the 2 largest accounting associations both provide for 10 hours of professional reading. FASEA have called for 5 hours on technical, 5 hours on client care, 5 hours on regulatory and compliance, however, 9 hours on professionalism and ethics. And our view is 5 hours on technical is simply inadequate. Technical is the most important part of CPD activity. As the tax laws change, as other key parts of our regulatory regime change, as new products emerge, that the technical training on that is absolutely critical, and it's much more important to stay up to speed technically than it potentially is to focus in some of the other areas. 9 hours on professionalism and ethics. I think one of our concerns is we really don't have greater detail on what that would involve, but we think it's simply excessive. Financial advisors will be required to study the Code of Ethics subject as part of the completion of their further education, and it will also be a core element of the exam. So we cannot see why 9 hours per year would be necessary. There are some, within the draft legislative instruments, some fairly tight requirements on who can deliver CPD. There's references to it being led and conducted, which implies a message around it being face-to-face. There's also discussion there about the academic qualifications and so on and the expertise of people presenting. These are things that need to be carefully considered because there are many people who can provide quality CPD activity and we wouldn't like them to be excluded. Each licensee will need to develop their own CPD policy, and this will need to be published on their website. Now, our question here is, there are over 800 individually licensed advisors out there in the Australian market. Do they all have websites? And is it practical to expect them to develop and publish a CPD policy? All advisors will need to have a CPD plan. Now, this new regime is set to start from the 1st of January next year. So we're talking about a couple of weeks' time. The policy hasn't been finalised. The legislative instrument hasn't been registered. A start date of 1 January 2019 seems to be entirely impractical. Now, it is noted that some of the obligations will kick in from the start of the next CPD year, but these requirements, these broader requirements around 40 hours and each of the designated areas start on the 1st of January. This, in our view, is unreasonable and unrealistic. Now, there's also no discussion of how a small licensee might be able to outsource these requirements, whether that's to an education provider, a dealer services group, or a professional association. Small individual license practices are not going to be able to spend their time developing CPD policies and approving CPD content. Now, the FASEA exam proposal came out last Friday. So we've started our analysis of this, but obviously this week our focus is also on finalising our submission on the Code of Ethics. What they've said in the draft legislative instrument and the other material in support of it is that the cost per attempt at the exam would be $540 excluding GST. And to some extent, we think this cost has been driven by the fact that they want it to be both a multi-choice exam and a short answer exam. And as soon as you go into short answers, you need to have people to do the marking, and that will obviously materially add to the cost. It will be a 3-hour exam plus 30 minutes of reading time. It will be on location, and it will be on computer when you get to the location. All of this materially adds to the cost. Now, whilst they've removed the notion of there being a limited number of resits, they've also made it more challenging to do resits because it will be at least 3 months between each attempt. And it may be significantly longer because you need to register, and you can't register until at least 3 months after your last sit. The content includes legal obligations, and that's Chapter 7 of the Corporations Act, which we would expect to be the primary focus. Also, it includes the Privacy Act, the AML-CTF legislation, but they've also added in a requirement to understand the TPB-approved courses on taxation law and commercial law, which we've certainly have concerns about. Other content of the exam will be the Code of Ethics and Code Monitoring and the advice process, although we think there's quite a lot that needs to still work out in terms of exactly what will be included in the exam, because some of the material they've provided to us, in our view, is yet to be adequately clear. Now, the blueprint document that was issued first on the 16th of November referred to the fact that preparation material and practice exams will be made available. However, we're conscious that there's no reference to that in the draft legislative instrument or the explanatory statement that went along with it. So the submission in response to the exam proposal is not due to the 4th of January. We encourage members to have a look at it and to provide their feedback back to us and also directly to FASEA if they wish. This is going to be a particularly important part of the whole FASEA regime. We're obviously very conscious that this is the first hurdle that advisors need to pass, because if you do not pass the exam by the end of 2020, then you will no longer be able to operate as a financial advisor. So this is a critically important part of the whole regime.
Bill, can I just interrupt with a question? We've actually had 2 people ask this same question, so thank you both Stephen and Neil. They both asked, if you do fail the exam, will you be able to continue to practice until you can resit the exam?
Yes, you can definitely continue to practice. So, as I said, you need to have passed the exam by the end of 2020. So there is another 2 years to pass that exam. You can sit the exam as many times as you can possibly fit it in, but I'm going to reflect back in a little while on the timing of this, because you need to do the study before you sit the exam. All right, let's keep moving. The other submissions that we've done so far, and I'll move through these really quickly. The professional year, we felt that FASEA had made some significant improvements in that they had reduced the number of formal education hours down from what was a ridiculous level of 800 hours to 100 hours. We think that's much more sensible for someone who's doing a professional year, where their focus should be on what they practically need to learn to operate as a financial advisor, not to go off and do further study. We still have concerns about the difference between someone who might play a role during the PY as the supervisor of the advice they provide and another person who might play a role as a coach. Excuse me. And also, one of the other things that we do really want to emphasise is during that professional year, there should be a really important focus on the client relationship skills. This is the stuff that great advisors learn over a long period of time as they deal with many different clients, experience very different things. It should be a primary focus where they can really leverage that expertise from the supervisors and the coaches that they work with, and the emotional intelligence that goes with it. Now, the term for a provisional relevant provider, this was a really, really simple one. FASEA have said that a provisional relevant provider, and relevant provider is the Corporations Act term for a financial advisor. So the provisional term, the term that can be used is a provisional financial advisor or a provisional financial planner. This is the easiest submission that I've ever done, and basically we went back and said, yes, we agree. Final submission that I want to quickly talk about, which is one that we did last Friday, is foreign qualifications. Now, we feel that there's a significant proportion of the advisor population that might have done study overseas, whether it's the UK, South Africa, New Zealand, or a range of other locations. What they've proposed is that if you're a new entrant, you would need to do a graduate diploma. Now, the career changer pathway already provides a graduate diploma option. And if you're an existing advisor, then the only avenue is to be assessed as to whether you have a relevant degree or not. So our conclusion of this is that FASEA have not actually delivered on the requirements, which is to provide a solution to approve foreign qualifications. For members who do have foreign qualifications, we invite you to contact us at the AFA and we can talk through this further. Right, the Code of Ethics. Now, I'm not going to go through the Code of Ethics today. However, there are 12 standards. There are 5 values. We are in the process of finalising our submission on this, and we'll make that available probably later this week. There is one really important point that I do want to make about the Code of Ethics and code monitoring. We have today announced that we will be participating with 5 other professional associations in an industry-wide solution for a compliance scheme and code monitoring. Now, we've chosen to do this, and we signalled this a couple of months ago, because we believe that an industry-based solution is a much better outcome than individual solutions from each of the professional associations. The Royal Commission has provided a focus on the way complaints are managed within professional associations, so a broader profession-wide solution delivers a better outcome. Doing it as a collective group will also deliver a significantly more cost-effective outcome. There is a material fixed cost involved in building a code monitoring solution. The outcome also, I think, really does emphasise the importance of the profession speaking with one voice, which is something that we have spent a lot of time working on and working with other professional associations across the entire FASEA process. So it will deliver a solution for our members so that they can be covered by the 15th of November next year, which is the date by which everyone needs to have signed up to a compliance scheme. Code monitoring starts on the 1st of January 2020. Now, those other bodies who we're participating with on this are the FPA, the Stockbrokers and Financial Advisors Association, FINSIA, the SMSF Association, and the Boutique Financial Planners. So this is an announcement that's coming out today. We will get a message to members in the next little while. It is an important development. It does deliver part of the solution under the professional standards regime. Right, I wanted to quickly talk about the timing and the implications for getting all of this done. If you're going to do, even if you're doing a bridging course, or if you're doing the graduate diploma, there are some core subjects, some of which will be included in the exam. So the Corporations Act, the Code of Ethics, the other legislative requirements, potentially inclusive, as FASEA has proposed, the taxation law subject and the commercial law subject, they would all necessarily need to be completed before you sat the exam. But we're very conscious that some of these subjects, particularly the legal obligation subject and the Code of Ethics subject, may not be available until the beginning of 2020. So if you haven't got the opportunity to study them, then we think there are particular concerns about being held accountable to a code of ethics for which you have not yet had the chance to study, and sitting the exam that will include material that you have not yet had the chance to study. So this is an important part of the whole regime, which we are providing a repeated feedback to politicians that the timing is becoming an increasing problem. Now, there's one last thing that I do want to finish off with on the whole FASEA process is the way these legislative instruments will be finalised. Now, there has been some suggestion recently, which we think is not well informed. This does not need to be passed by the Parliament. Legislative instruments, it's like regulations. They can be set by the government or an instrument of government. So FASEA has the legislative powers to set legislative instruments. They then need to be registered and tabled in the Parliament. They do not need to be voted on by the Parliament. However, any member of either house can seek to disallow a legislative instrument. Now, once they're tabled, each member of either house has up to 15 sitting days in order to move a motion for disallowance. And then the Parliament needs to make a decision on that motion within a further 15 sitting days. Now, this is going to pose an interesting challenge because of the election next year, and the government has set a very restricted window of sitting days. Both houses will be sitting in the middle of February, and the House of Representatives will sit again on 3 further occasions. But the Senate at this stage isn't proposed to sit again before what we expect the election timing to be. So it may take some period during the course of 2019 for that window of opportunity for disallowance to play out. However, we still have the big question is, who's going to move a motion for disallowance, and could you actually genuinely expect that it would pass in either house? We don't really expect, in the context of the focus from the Royal Commission, that substantially reducing the education standards for financial advisors is a likely outcome. We thought it was appropriate to brief you on this process for the approval of legislative instruments, and we welcome any questions that there might be. Okay, should we just pause for a moment there to see if there are any further questions on FASEA before we move to the next section?
We do have a substantial amount of questions, Phil, so I'll just make a quick note that if we don't cover your question during the webinar, we will try and either contact you directly to answer your question or develop a question and answers, a frequently asked question sheet that we'll also send out post-session. Like I said, we do have a significant number of questions here, so I might try and sum up a few of the similar ones. Regarding the publishing of a CPD policy, Stephen's asked, is a Facebook page for business considered the same as a website? to be able to publish your CPD policy?
That's a very good question. I think we'll take a note of that and give due consideration. We've certainly proposed that it is unreasonable to publish these things, particularly if you're a self-licensed practitioner.
Now, this will be a bit of an amalgamated question on a few of the ones that we've sent through, and particular thanks to Stephen and Daryl for this. They've brought up the testing of the Ethics and Corporations Act and saying if you have to cover the subjects in the exam, why do you have to then go forward and pass the units on those same subjects?
Yeah, now a good question. This comes up on a regular basis. The reality is that it's part of the law. The law requires advisors to pass the exam and also to achieve what's termed degree equivalence. Now, we can't change the law, FASEA can't change the law, and the Parliament has no intent to change the law, whether they disagree or not. So what we're trying to do is say that the study to prepare you for passing the exam should also count towards achieving degree equivalence. So that's the line of argument that we're working with.
Now, Daryl also asks that given everything isn't ready for the exam from the 1st of January 2019, why shouldn't we be pushing for a later date than 31st of December 2020 to have passed the exam by? The actual period will be less than 2 years to pass the exam if the period does end on the 31st of December 2020.
Yeah, and that's a point that we have raised in our discussions with the Minister and a point that we have raised in our submissions with FASEA in the past. The practical reality is that FASEA does not have the ability to change those dates. The Parliament does, and potentially the Minister and ASIC might have some powers to modify those dates. That is something, as I set out in that slide where we showed the timing complications, that we will continue to place a big focus on and will certainly be advocating as we progress further with this. But all the signs are that the study will not be available until early 2020, and then how can you get it all studied in time to pass the exam? So it is something we're very conscious of.
And Tony puts the question forward again on the exam. Would you only resit parts of the exam that you didn't pass?
It is our understanding from having the first read of that standard is that they are not going to take a modularised approach where you would, say, have the 3 modules, and if you pass 2, you would only have to come back and reset the one that you didn't pass. That's something that is not obvious in there, so we believe it's not the case. We certainly argued in the first round that it should be.
Having a look through, Robert asks, can we please confirm which Privacy Act that will be assessed? The Commonwealth, New South Wales or Queensland Act, and makes a point to say each state actually have their own Privacy Act.
Right, I think that it'll be a national training, so I'd assume it's going to be the national policy, but we'll take that point on notice.
And we do have a question from Therese. When can we commence the registration for the exam?
Well, good question. I think that the message in the communication was that the exam may become available from the middle of next year. They have appointed a provider, but other than that, we don't have any timing. All right, we will have time at the end, hopefully, for further discussion on any questions, but I will keep pushing forward. So I'm going to talk now about the Royal Commission. This has been a factor that has been on the radar for the entire course of this year. Our work started back in December last year when the AFA was asked to provide a submission to the Royal Commission. Since that time, there have been 4 rounds that have been most particularly relevant to financial advice. So round 2 back in late April, where we saw all of the advice matters discussed. Then in August, round 5, the discussion on superannuation. In September, the round on insurance. In November, then we had the final round and discussion on policy matters. We had the interim report released on the 28th of September, and then the final report is now due in February of next year. So that's now just a matter of potentially 6 weeks away. The AFA did submissions to the Royal Commission in response to rounds 2, 5 and 6, and also in response to the interim report. Our submissions are available on the website. Now, I just want to quickly reflect upon some of the questions that came out of the interim report. And these are questions that really challenge, I think, the core of financial advice. Can conflicts of interest and duty be managed? We saw a lot of discussion and a lot of, I guess, opinion put forward around the need to remove conflicts of interest. How far can and should there be separation between advice and product, which gets to the question of vertical integration? Should the grandfathered exemptions to conflicted remuneration be changed? Should the life risk exemption to conflicted rem be changed? Should all financial advisors be individually licensed by ASIC? Should platform operators be permitted to deduct fees on behalf of licensees without the express authority of the client? And should the opt-in period be reduced from 2 years to 1? So some of the implications out of these questions, and it comes out of reading the submissions and looking at how they conducted the hearings, is there is obviously some consideration being given to whether charging ongoing advisor service fees from superannuation accounts should be continued to be allowed. The strong focus on grandfathered commissions leads us to assume that there will most probably be a recommendation on that in the final report. Will there be any recommendations around the future of vertical integration? And will there also potentially be some further recommendations with respect to life insurance commissions? And with opt-in, is there a risk that they may recommend that it is extended to include pre-1 July 2013 clients, and whether the frequency should be reduced to every year? Now, I just want to reflect on here a statement that was made by Rowena Orr in her introductory statement to the final round of the Royal Commission on Monday, the 19th of November. And she talked about the submissions in response to the interim report. She made a comment that basically the entire industry has conceded that grandfathered commissions should go. However, she then went on to say, of the industry submissions received by the Commission, only the Association of Financial Advisors was wholly opposed to ending grandfathered commissions. Now, what I want to do is just pause to talk about what our actual position was, because I think she's defined it in a too simplistic way. But also wanted to bring this to your attention because it reflects the groundswell of momentum and, I think, policy intent around this particular issue. Now, we have summarised in our submissions a position on grandfathering, and it really comes down to the outcome for the client and the situation that they're in. So we look at this in terms of whether the client's in a broadly competitive product or an uncompetitive product, and on the other dimension is whether they're getting service in return for that trail commission or not. So we're saying that if they're in a broadly competitive product and they're getting service, then no action is required. The client is not being disadvantaged. If they're in an uncompetitive product and getting advice, then there must be a reason why they're there. And we think that licensees need to analyse that and understand. If they're not getting advice, well, our view is quite clear, and it reflects now on what community expectations are. Community expectation is not that you can receive a payment if you're not providing a service. No matter what the original origin of trail commissions are, community beliefs is that not providing a service is no longer acceptable. So that needs to be dealt with either by the licensee taking action to ensure that they are getting service, or moving them, finding a way of moving them to a competitive product. Now, this is a much more complicated issue than is being framed by any of the discussion. At the end of the day, if grandfather commissions are to be removed, then the only party that should benefit from this are the individual clients themselves. Very few products actually allow for trail commissions to be rebated directly to clients. And it's interesting to note that with older systems and older products, this is going to be incredibly problematic to solve. And there are obstacles that prevent clients from being moved, whether that's exit fees, exposure to capital gains tax, Centrelink grandfathering treatment for deeming, insurance, and maybe the cost of moving. Our argument is this is much more complex than has been framed in the whole discussion. With respect to ongoing service agreements, you may have seen a recent article on Professional Planner where there was a focus on whether the Royal Commission will make a comment in this area. Certainly we're comforted by a large number of parties who've come out and supported the continuation of this. I want to just now reflect upon the positions of some of the key associations so that our members do get a sense of the advocacy that is going on. Banning ongoing service fees from a superannuation account, which we've just talked about. FASEA, the FSC have certainly said that they don't support that. Neither have ASFA. The ISA, who I must say their submission to the interim report was in many ways a manifesto for the destruction of the financial advice profession. They said ban it entirely. And I've introduced the FSU into this table because there's been quite a bit of discussion recently about what role the FSU may play in some of the discussions that are going on at the moment. They have not supported a ban on ongoing service arrangement. No one's really come out and made the suggestion to ban vertical integration. With grandfathered commissions, the FSC has supported a ban. ASFA, the Super Funds Association, has supported a ban and suggested that it should happen within a year. The ISA have said ban it now. The FSU have also called for a ban on grandfathered commissions. With life insurance commissions, the FSC has supported the retention of them. ASFA didn't comment. The ISA, unsurprisingly, have called for a ban on life insurance commissions. And also the FSU have called for a ban on life insurance commissions. In terms of annual opt-in, the FSC have opposed it. Now, I do need to point out that they have, however, gone on to say that they think opt-in should apply to pre-1 July 2013 clients. ASFA didn't comment. ASFA said, well, if ongoing fees were banned, then it wouldn't matter. But if they weren't banned, then they would certainly support moving it to annual. And the FSC didn't comment. Another couple of relevant points here is that the FSC have said that where conflicted REM, grandfathered conflicted REM, was to be banned, then so far as is possible and practical, it should be redirected to clients. That's really not a starting position here. Any benefit necessarily would need to flow to clients. It could not and should not end up with the product issuers. Now, the FSU's position on grandfathered commissions and insurance was reinforced with other submissions that they've done to the Royal Commission.
So I might just interrupt with a question here because again, we've had a few questions come in that are similar, and it's around the term for grandfathering. So Murray's asked, what about life trails? Are they part of grandfathering? And Peter's asked, does the term grandfathering apply to all commissions, including retail risk only for risk riders?
Okay, so I think that the key point here is that trail in this grandfathered context is used to describe investment and super. Now, when we talk about insurance, it is not grandfathered. So upfront business that was sold on 100% plus and 10% trail is not above the threshold that the life insurance framework sets. So there's a threshold of 20. It is consistent with the current law, so it is not grandfathered. So when I talk about grandfathering, I'm talking about investment and super. I don't think the same issue applies when it comes to life insurance. All right, now I do want to talk quickly about life insurance. There has been discussion, obviously, at the Royal Commission as to whether life insurance commissions should be allowed to continue. And obviously, we are strongly advocating for the continuation of life insurance commissions, which we think are fundamentally in the best interest of clients. There is no international comparison that would suggest that clients get a better outcome from the removal of life insurance commissions. They are a very different clientele to the typical clientele for superannuation and investment products. Now, the process here is that the lift is underway. We will see on the 1st of January next year a reduction to 70%, and then on the 1st of January 2020, there will be a further reduction to 60% for upfront commissions. What is really important to us is just to emphasise the fact that this is still in play, and the benefits that the government has thought will be an outcome of that in terms of the quality of advice, whether we accept that or not, is yet to play out. And this process needs to be allowed to play out. It has been agreed that ASIC will do a review in 2021. We think it's totally inappropriate for any further change to be made before that process is allowed to play out. We are, however, very conscious that ASIC have made clear through their submissions that they already have a clear view on life insurance commissions. We've included a couple of extracts there, including the fact that they had formed the view back in before the 2011 submission as part of the FOFA reforms that they thought life insurance commissions should be removed. And they've also made reference to their report 587 on direct life insurance, and somehow have concluded that that report on direct life insurance is a factor that should lead to the removal of all bans, including life insurance commissions. We do not see the link between report 587 on direct life insurance and any suggestion that life insurance commissions should be removed for financial advisors. Right, I want to now move on. We'll reserve some time at the end for questions. Just quickly on legislative reform, there are a couple of key pieces of legislation that's currently sitting in the House. The Protecting Your Super package was a reform that was going to substantially impact life insurance within default superannuation. Some of the key things in this were that people under the age of 25 or with balances of less than 6,000 or with inactive accounts would move to an opt-in basis, and they could lose their insurance cover. We were particularly concerned about the impact that that would have, not only for the clients of financial advisors who might be sitting in some of these superannuation products where they do have cover, but also for the broader population. The government has also recently introduced legislation to introduce additional responsibilities in terms of design and distribution of products, and in terms of ASIC intervention powers. From an advisor's perspective, this would add additional responsibilities around record keeping, and we wanted to ensure that that was as pragmatic as possible. Both of these pieces of legislation are yet to make their way through the Senate, and they're currently sitting there. And in the context of what's happening with an election next year, the timing of these pieces of legislation is unclear. In terms of regulator activity, we've seen an ongoing focus on fee for no service. We've also seen ASIC recently launch a new project around FDSs and opt-in, and we ran a webinar on this a little over a month ago. They are continuing to look at life insurance advice as part of collection of the statistics that they get out of the life insurers on lapse rates and other information. It is very clear that ASIC, just like all the regulators, are going to place a lot more focus on enforcement, and that's going to lead to court-based activity. We've seen that play out already, and we saw an announcement yesterday. We also expect that ASIC will have a continuing focus in terms of follow-up on some of the reports they released during the course of 2018. Report 562 highlighted 75% of advice was, in their view, inappropriate, and report 575 on SMSF advice produced a result of 91% of advice being inappropriate. We expect that there'll be follow-up activity in that area. Expectations for 2019, before we go back to questions, I think it's really important that we understand this in the context of some of the big reforms that are happening at the moment and what might play out in a political context. The government has now lost its majority in the House of Representatives. It already reliant upon the crossbench in the Senate. With the loss of the Wentworth by-election and the defection of Julia Banks, they are now very much in minority. In terms of the election timing for next year, the government has already signalled the likelihood here. They've said that they will introduce the budget for the 2019-20 year in April. Normally that would be in May, so bringing it forward is a clear indication. It is very likely that the election will be on either the 11th or the 18th of May. My money is on the 18th of May because that's the last possible date that they can go to an election and have the new Senate in place for the 1st of July. There are very limited sitting days before the election. We do not expect a great deal to get passed, and more than likely we will move to an election mode fairly early in the year. Now that makes us focus very much on the Royal Commission final report, which is due out in February. We don't think it's likely that there will be a significant amount of immediate legislative action. However, it is quite probable that the report will become part of the election campaign, and we need to be very conscious of that. Next year will be very interesting to see how it plays out in the political context and the flow-through consequences for financial advice. I think it's important that members have an understanding of what next year will look like in a political context, because next year will be a very important year for how the Parliament responds to the Royal Commission final report. That's got us to the end of the formal stuff. I think we've got 5 minutes left for questions. I'll pass back now to Mark and Angela.
We did have some questions around, are the courses available now to meet the FASEA requirements? And if not, do we know when they'll be available?
So I think that's a really good question. There are no approved graduate diplomas right now, and it's not clear to us how soon they may be available. The subjects around the Code of Ethics and the legal obligations have not been built or will not have been built. And how long will it take higher education providers to build those? We still recommend that people hold off on starting their study until there is more certainty. But we would strongly encourage people to start thinking about it as soon as possible.
Now, we did have a question around designations, and will a foreign CFP be accepted for credits?
Right. There's no obvious provision for that. It'd be interesting to see whether a foreign professional association wanted to apply for it. So at this stage, I don't know the answer to that question. I might just take a step back to the previous question. People do have the ability to start a approved undergraduate degree or an approved master's degree. There are already approved master's degrees. So if that's what someone wants to do, then we wouldn't discourage them from doing that. So I just want to, that's an important piece of clarification. There are no approved graduate diplomas, but there are approved master's degrees.
Thanks, Bill. Gavin asks, how will the education requirements impact responsible managers for AFSLs?
A good question. Now, recently, ASIC has put forward a proposal that at least one responsible manager in a licensee would need to meet the FASEA requirements for education, the exam, and CPD. That's consultation that hasn't been finalised, but that's clearly a proposal of ASIC.
Andrew's asked specifically on the exam, can you give your thoughts on the legislative instrument outlining that the exam pass is at the credit level?
Someone who's read the detail, fantastic. We were intrigued to see that in there without any explanation or clarification. People who have done university study would understand that a credit normally is based upon a 65% result. So that is our interpretation of it, but it's certainly unclear. Well done. Good question.
Now we've got a question from Paul around the CPD, and he asks, will there be a requirement to complete CPD over a financial year or a calendar year, or will there still be flexibility for a licensee to decide this?
Definitely flexibility for the licensee to decide. Licensees need to notify ASIC of their CPD year, and they can choose whatever that might be. So we wouldn't expect CPD years to change at this stage.
Looking at the RPL guidelines, a question from David. David asks, will universities follow FASEA or use their own RPL guidelines?
Well, I think that's an interesting question, and it's unclear at this stage exactly how it's going to play out in terms of the final decision around RPL. However, FASEA have made it clear that for existing advisors, the only RPL that they can get is for the ADFB or equivalent or for a professional designation. So for the education provider to go outside those Okay, we might have lost coverage very briefly there, so I'm not sure if we are back online. My apologies for that. I'm not sure exactly what's happened. Mark, can we just go back to that question?
So there was a question around who will decide the credits available.
So it really is, in our view, unclear, and it will depend upon whether it's a graduate diploma, in which case we would expect that it will be the education institution. If it's a bridging course, then it may actually be the licensee or FASEA that would need to decide.
Yeah.
All right. Well, I think it's probably in the context of the issues that we're having, maybe it's appropriate. We are at time, so I might suggest that we wrap it up there. If there's anyone still listening, thank you very much for participation in this. have a Merry Christmas, and we certainly look forward to working with you next year as we progress with these key reforms impacting our profession. Thank you very much.